Holiday season's here. Let's talk about U.S. holidays and their impact that they have on the markets. And what I want to do is I really want to talk about what happens to the end of the year. But, if you take a look at this particular strategy as a whole, there are 10 U.S. market holidays that happen throughout the year. We have one almost every single month where banks are closed, markets are closed, and we're able to take a look at that, run some data through it, and see what happens before that holiday, after that holiday, and even between the holiday. And so all but Juneteenth have enough years where I can go back and look at a decade's worth of data or more to evaluate patterns. Right now, the theory is that the markets are stronger the week before the holiday and they're weaker after the holiday. But how true is that when you look at the home stretch, which is the year-end holiday season? I'm talking about Thanksgiving, right? The Thanksgiving holiday, everybody's gearing up. If you've noticed, there's already Christmas merchandise that's on the shelves. In fact, it's been on the shelves since before Halloween. But this being the official start to the holiday season, we thought we'd take a look at what's happened before and after Thanksgiving, just looking back a few days prior. So the holiday trading pattern, the one that's typically looked at amongst any traders that look at patterns such as these, is they like to buy an ETF the week prior to the Thanksgiving holiday. And then typically what they'll do is they either get out of it right before the holiday, and I've seen people hold it for the week after, kind of betting on that there's going to be this increased buying pattern that happens after Black Friday. So what did I do? Well, I ran the numbers, I took a look at the results, and guess what? The last decade actually looks pretty good. Here's what I'm talking about. So let's start with the DIA. This is the Dow Jones Industrial Average. When you look at the Dow Jones Industrial Average, what are you seeing here? We're seeing that if we look back 10 years, and we see here that over the Thanksgiving holiday, if I'm looking at the 5 days before Thanksgiving and the 5 days after Thanksgiving, with 250 different tests, here's what I found out. Really, the 5 days before and the 5 days after actually come out on top with an average percent return of 1.34%. That means that in the last 10 years, the market on average has moved 1.34% 5 days before to 5 days after, those 10 market days. Okay? So, we can look at things like average profit, but here's the other part. This has happened 7 of the last 10 years. Not exactly my favorite pattern, but a good one nonetheless. And look what happened last year. The DIA was at 345 when this pattern started, and it ended above 355. Nice move for the DIA. The 3 years that it lost money, 2015, 2019, a smidget, and in 2021, the big pullback. Remember what happened in 2021? We started to see the rates going higher. All right. This looks like I didn't change the screen, but I did. This is a look at the SPY. Again, same 10 years, same Thanksgiving holiday, looking 5 days before, 5 days after, 250 tests it ran. And in this case, the 5 and 5 returned 1.27%, actually less than the Dow Jones Industrial Average. But there's a silver lining to this. 8 of the last 10 years, it was profitable, right? The only 2 times it lost money was in 2015 and again in 2021. And last year, we started out below 450 on the S&P during this 10-day run, and we closed above 456. So again, less results, but it worked more often. Hey, I'm Tom Gentile, America's Pattern Trader, and markets get rocky this time of the year. But this isn't my first rodeo. But the money counter is still delivering stock patterns with a 90% or better probability of profit, even in September, one of the bearish months in the market. Hey, get the patterns, the trades, and my playbook for just $9. Looked at the Dow, looked at the S&P. You know which one we're going to look at next? The QQQ. And the QQQ ended up with, it was double dipped, meaning in a good way. All right. 5 and 4, 5 days before, 4 days after. actually averaged 90% accuracy. The only time it lost money was back in 2021, just like the other two indices. But every other year, this thing made money. And if you look at the last few years, it's actually done very, very well. In fact, notching a 5%er there in 2020, getting close to 4.5%. And then last year did pretty well too. In fact, we started somewhere down around the mid 380s and we ended in around 390. So again, 1.42%. Average profit was $2.81 and 90% accuracy for the QQQ. So if I wanted to trade QQQ, I wanted to take advantage of this particular pattern. I said, you know what? I like this pattern. Let me see what if I were to buy today and hold to the end of next week. What does that look like? Well, I queued up the Qs, and this is coming right out of Robinhood. And so very recently, we're seeing the QQQs. If we were to buy the call options that expire on December 4th, okay, the 603 calls were the at the money. They were closest to the money we're looking at. And I was looking at the 603s, and the 603s were priced for $9.61 at the time I snapped this and then enlarged it for everybody. So think about this for a moment. If we are looking to make let's call it 1.5% on the Qs. All right, if we're going to make 1.5% on the Qs, just buying the Qs and selling them 10 days later for that average 1.5% return. What am I going to, if I pay 1.5%, this is actually a little more than 1.5%. If I pay 1.5% for the 10-day call option to make 1.5%, what am I doing? You know what I'm doing? I'm basically trading time for real value. And that's if the Qs go up 1.5%. So I don't want to buy a 10-day option and spend 1.5% of money on that, knowing good and well that the average move on the Qs in the last 10 years during this time frame was only 1.5%. I'm breaking even at best. So how do I take advantage of this pattern in the market, but yet at the same time spending much less than the $9.61 it would cost to get into this? Well, easiest way that I can do that is by looking at a short-term call spread. Now, call spreading, what that does is that we'll buy that long call, but what we'll also do is we'll simultaneously sell a higher strike call. We'll buy something at the current price we were looking at before, but what we're going to do is we're going to sell something above that and take that money in, and it helps finance the strike that we've bought. Right? What that does is that lowers the cost of the overall trade. It lowers the risk of the overall trade. And now, if the Qs trade up 1.5%, the difference between the two is what we're looking to make. It lowers our break even as well. Let's take this strategy and apply it to the information that we just found out. So if we took that 603 call option, and we bought that lower strike call, right, with that December expiration, and we sold the 608. So we're going to buy the 603, and if we sold the 608, that's a 5-point bull call spread, right? Right now, it's pricing in at around $2.82, which means that in order to get to break even on this trade, remember what break even was on the last one? It was $9.60 some odd cents above 603. This one's only $2.82 above 603 because you take the price of the entire spread contract and you add it to the strike you're long, and that gives you your new break even at expiration. Much less. So if we get to 608 or above 608, this $2.82 come next week, December 4th, if we're above 608, is going to price out at $5. So if I paid $2.80 for something that's worth $5, I made much more than that 1.5% move on the Qs. In fact, I end up making somewhere around 40, quite a bit more than that. It's not quite a double, but it is definitely in the high high double digits. Not 100% return, but in the high double digits versus buying the call option. So our holiday summary sums up like this. The Thanksgiving holiday has seen markets moving higher the week prior and the week after, looking at the last 10 years data. Now, historical data suggests this has occurred 9 of the last 10 years with positive movement, especially when you zone in on the QQQs. And finally, using a short-term at-the-money call spread can greatly reduce our cost and our risk when we compare it to straight-up buying calls.